What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about options. We're going to go through what they are, how they work, and how you may want to incorporate them into your trading. Okay, options, real simple. What is an option? An option is the right to buy or sell a stock at a specific price on or before a specific date. Really simple. So let's put this into an example so we can better understand it. Let's say you think Apple is going to go from $10 to $20 at the end of the month. So I know that's not the right price, but let's just say that's based on your technical and fundamental analysis. You think the stock is going to go up. Well, you can go out and buy an option for it. So in this case, you can buy an option to purchase Apple stock at a price of $14 on July 28th at a cost of $1. So that is how you would describe an option. And in order to better describe that, we do have some terminology. The terminology that we use to describe the price at which you can buy or sell that stock is called the strike price. The date at which that contract is good until is called the expiration date. So this one is good till July 28th. In this theoretical example, the expiration date is July 28th. And the cost to put all of that together, to put that contract together, we call that a premium, and the cost in this case is $1. So in theory, you're paying $1 today for the right to buy Apple stock at $14 on July 28th. Therefore, if Apple is $20 on July 28th, you will be able to buy it at $14, sell it at $20, and you'll be able to profit $6. Now, you will have paid $1 for your premium, so you will have $1 invested, you'll get $6 back, your total profit on it will be $5. That's how an option works. So, let's say that you execute the option, you pay your $1 premium, July 28th comes around, you decide to execute that option, your strike price is 14, so you actually go into the market, you execute this option, and what you do is you front all of the money in order to buy the stock, and then you own that stock, and the market price on that day, remember, is $20. Therefore, you currently own one Apple share, and you can sell it at $20. You only paid $14 for it, so you gross profit the $6. You paid $1 for your premium, leaving you with a $5 leftover profit, and you have an ROI of 500% on that investment. Really good option there. Now, let's say you had bought this stock. So just a theoretical example, the exact same scenario. The stock goes from $10 to $20 and you had bought the stock. It means that you had outlaid $10 up front instead of $1 for your premium. You outlaid a full $10. You sold it at the end of the month for $20, so you made $10 on that investment, but you fronted $10 as well. It gives you an ROI of 100%. You put in 10, you got out an extra 10 back, whereas with the option, you put in 1 and you got an extra 5 back. So a little bit different risk reward here, and that's the big thing with options that you need to understand, is it goes off the movement of the stock, but it is much higher risk and reward. So when we compare them and you look at having bought the stock compared to having bought the option, you can see that having bought the option would have given you a much better return in this specific scenario. Now, this is a theoretic scenario. Not all of them are going to play out like this, obviously, but in this scenario, it would have given you a much better return. Now, there are two different types of options. There are call options and there are put options. A call option is exactly what I just described to you, where you have the right to buy a stock at a certain price and you hope that the market price at expiration is going to be higher than that. The other option here is the ability to sell the stock. That is called a put option. It is the exact opposite of a call option, and the idea here is that you want to make money when the stock goes down. Therefore, you are guaranteeing yourself the right to sell the stock at a specific point. For instance, if Apple goes from $10 to $5, you could buy a put option that gives you the right to sell the stock at $8. Therefore, if Apple drops down to $5 at the end of the month, you can buy it at $5, you can sell it at $8, and you can make that $3 gross profit. That is how a put option works. It is the exact opposite of a call option, but you're making money on the downside using the same principles and the same techniques. All right, now when we talk about options, one of the things that we have to touch on is the term called contracts. A contract is what your options are sold in. Just like your eggs are sold in a carton, your options are sold in a contract. And a contract is equal to 100 shares, meaning that every time that you go out to buy options, your minimum investment is going to be one contract, and that contract is going to be options for 100 shares. So if you buy an option, like the example we just went through, where you're paying a premium of $1 per share, that's exactly what we looked at in this scenario. Your minimum investment or your minimum ability to get into that option is to buy one contract, which is going to be 100 times the premium that you paid, meaning $100 in our scenario. So for us to buy any options in our scenario, we would have bought one contract and it would have been worth 100 shares, and that would have cost $1 each. I know I'm using one a lot here, but basically what I'm trying to say is you couldn't just buy one option for one share. You have to buy it in a unit of 100, and that comes as a contract. Now those contracts can be sold up to expiration. Now that's the nice thing here. In our example, we looked at executing that option, so we actually bought it at 14 and sold it at 20. But what you can also do is you can sell that contract all the way up to expiration. So if you don't have the cash to actually fund that transaction where you buy the Apple stock, you can just sell the contract a day or two before at market value, and it's going to give you close to the same return. So that's what's really nice about these, is you have liquidity all the way up to expiration, and then at expiration, if you actually want to own the stock, you can get into it by buying it that way, or you can get into it, buy it, and sell it immediately for a profit right away. So lots of different options. Me personally, I will never exercise my options. I will always buy and sell the contracts all the way up to expiration, but I will never exercise them because I don't want to outlay all of that money, and I don't actually want to own the stock. I just want to make the difference on that day trading. So okay, so real quick, just a couple of things that I want to touch on. Options have a much higher risk and reward profile. They're not going to move 1 or 2% per day. They're going to move 5, 10, 20, 30% per day. So you need to be aware of that, and you need to be able to manage that volatility. Secondly, they're much more complicated. As you can see, they incorporate time, they incorporate certain price levels. You need to get to certain price levels at certain times. So they're much more complicated than just buying and holding certain shares. So you need to be aware of that, and you need to understand that, especially as you get into this. Thirdly, they can be used to hedge your trade. So let's say you're really long on Apple. You've got a lot of money in Apple thinking they're going to do really well, but all of a sudden you're worried about China. Well, you could buy a put option that's going to cost you a very small amount of cash because all you have to outlay is that premium. But if Apple drops, you'll make a very large return on that put option to hopefully offset the loss for your long position, and then you can just continue to hold the stock and collect that dividend if you really like it. So that is one option that you can use these types of strategies for. Lastly, I do have a free course on Skillshare. Now it goes way more in depth into options than what I've covered in this video. It breaks everything down, including theta, delta, all of the Greeks behind it, all of the different strategies you can look at and how to combine different options. So there's lots more information on options and lots more to dive into. If you're interested in learning that, you can get 2 months totally free on Skillshare with the links below. You sign up there and you get access to all of my courses totally for free for 2 months. I've got a full course on there with like 30 lessons of how to trade options. So you should definitely check that out, and don't forget to subscribe. Sincerely helps my channel out, and I would sincerely appreciate it. Thank you so much. My only goal is to help you out some more and make more money. So hit that subscribe button. We'll talk to you soon.